Hi, welcome back to another edition of Lipper's Fund Flows Insight. My name is Tom Roseen. Thanks for joining me today. I'm going to be reporting estimated net flows for the conventional fund business for the week ended Wednesday, September 9th, 2020. In each of the particular sections, we'll talk about ETFs and their impact, but the top line numbers I'm going to be talking about right now are really for conventional funds. We saw that for the fifth consecutive week, we suffered outflows this week, and this time to the tune of about $28.6 billion. And I don't think anybody would be surprised by that number considering what's been going on in the market. Basically, we saw one of the biggest and fastest 3-day slides in the NASDAQ that we've seen on record. I believe it was on record anyways. Basically, the NASDAQ from September 2nd until September 8th, keep in mind that Labor Day fell on the 7th, so a 3-day period as far as trading days go, saw about a 10.03% decline, which it qualifies for a correction. And basically, though, by the next day, on Wednesday, we saw that the people went out there, investors went out there and basically bid it back up. And so the NASDAQ finished that week out, the fund flows week, with a decline of about 7.59%. And keep in mind, this was after we had some really good news. Basically, we heard that the non-farm payrolls for August came in stronger than expected. About 1.4 million jobs were regained into the economy. Unemployment rate dropped about 8.4%, but two things. First of all, the president threatened China that it was going to decouple the U.S. from China. The economies were going to be separated, and people, are taking kind of that Sino-American tensions to heart right now. And additionally, I think many investors thought that the market was getting a little dear, a little pricey, and basically took some of those hard-won profits off the table. So despite the big outflows that we saw, really, again, when we get into the numbers, you're going to see that it was almost all money market funds, and I think that will be a surprise. Investors weren't chasing performance either way. So let's go ahead and take then a closer look here and see how it panned out. And let's take a look at the macro groups first. Basically, equity funds lost about $7.8 billion in net redemptions. Taxable bond funds took in about $5.9 billion. This week. And then we saw muni bond funds take in $749 million. And like I said before, money market funds were the culprit. The main reason that we saw massive outflows, basically we saw was a $27.4 billion outflow, and I think that pretty much changed a lot of attitudes as far as investors chasing performance and the like. I think a lot of investors are actually sitting pat. We did see some big outflows. We're going to see that in a second, but again, not as big as the NASDAQ route. Certainly may have pretended if we take a look at kind of a history of big outflows and big market moves. So let's go ahead and take a play-by-play look at each of the groups. Let's first pay attention to what happened into the equity arena. And basically we see that equity funds for the first week in 11 suffered its first big decline. It lost about 4.35%. Keep in mind, I told you that the NASDAQ lost 7.59%. So a good diversified portfolio overall. When we're talking about average equity fund, lost about 4.35%. Now, on a dollar value, it's a 20th consecutive week that it saw outflows. Keep in mind, I said it was the first week in 11 that they've seen negative returns, right? But it's a 20 consecutive week we saw outflows. This time to the tune of about $7.8 billion. How this broke out is domestic equity funds handed back about $6.2 billion, and then we saw that was the 13th consecutive week, and we saw a return of about 14.97%, and it was the first week in 3 that it actually saw negative returns as well. Now, if we go to non-domestic equity funds, we see that it lost about $1.6 billion. Third consecutive week, it lost money, and it had a negative return of about 2.95%, and it's the first week in 11 that it saw negative returns. So that was quite a story there. But really how it broke out, we can get in a little bit more detail. Large cap funds handed back about $4.3 billion, and small cap funds handed back about $482 million, while international equity funds lost $1 billion, and global equity funds lost about $610 million in net redemptions. So let's go ahead now and turn our attention to the ETF side of the industry, which I was telling you about. Let's take a look at the ETF group and see how that panned out. We see equity funds for the second consecutive week took in net new money, this time to the tune of about $6 billion. How it broke out, though, is we saw the Spider S&P 500 SPY ETF taking about $7.4 billion, and the ProShares Ultra Pro QQQ ETF took in about $1.1 billion. So we see that people are actually trying to use leverage to get money back, and I think this is where we're seeing a lot of the volatility, is people taking these type of positions, maybe even shorting some of these securities, and we're seeing a lot more volatility that we've seen. Basically, if we look at the bottom side of this graph, we see the Consumer Discretionary Select Sector Spider Fund losing about $762 million, and the iShares Russell 1000 Growth ETF handed back about $433 million. So again, the tale of two cities here. We saw that the retail investor, again, was the net redeemer overall, and we saw ETF investors actually put money to work. I think they're thinking that there will be a big turn in values, and we have seen continued ups and downs, and certainly volatility is going to stay ever present for quite some time. Let's go ahead and take a look now at what happened to our fixed income group and see what was in store for us in that area. Fixed income funds for the 22nd consecutive week took in money, about $5.9 billion this week that we saw as far as net inflows go. And it's the first week in 3, though, that we saw negative performance. This time, only to the tune of about a 0.88% loss. So not a lot to write home there. Certainly we've seen some stuff in the yield curve going on at the long end, maybe a little bit of inflationary pressure. So that's why we're probably seeing it. Prices rise, the yields go down. When we see that type of inflationary pressure. But anyways, the main group that took in money was the corporate investment grade debt funds, took in about $5.2 billion, while government treasury and mortgage funds, a little bit of flight to safety there, took in about $253 million. And on the downside, we saw that balance funds actually lost only about $167 million overall. So really, the fixed income fund has been continuing to go on, and we have seen some, if you will, running from treasuries and embracing of not necessarily high yields, but a little bit riskier assets, and people are willing to go in corporate investment grade, triple B or above type of investments. I think they're looking for a little bit more quality in that case. Well, let's go ahead and see what the ETF investors basically did this week as well in the municipal in the taxable bond fund arena. Basically, we see that they took in about $601 million, so not a lot to write home about. Third consecutive week, though, they've taken in net new money. But at the top of the group, when we take a look at it, is iShares U.S. Treasury Bond ETF only took in about $263 million. The iShares Core U.S. Aggregate Bond ETF took in about $238 million. And on the downside, we see that this kind of running from the long Treasury end of the curve, iShares 20-plus year Treasury Bond Fund, or I should say ETF, lost about $766 million, and the iBox Dollar High Yield Corporate Bond ETF lost about $702 million. So a little bit of difference there. We see that the retail investor is still very comfortable putting money to work in the bond fund universe, and again, ETF authorized participants weren't quite as thrilled with the bond fund side of the universe. Well, let's go ahead and see how this actually panned out for our muni bond funds. We've seen a pretty long run for municipal bond funds as far as inflows go. $749 million this week. It's 18th consecutive week they've taken in net new money. But it's the first week in 3 they've had plus side returns, this time to the tune of 0.03%. So not a lot to write home on this one either. The group that took in the biggest amount of money, and it's been kind of a leader for quite some time, General Insured Municipal Debt Funds took in $354 million, and the Short Muni Debt Group took in about $311 million. And remember, I told you, people are kind of, even though they're in a hunt for yield, high yield munis actually suffered. I won't say there was a couple of small net redemptions, but this one was very small as well. High yield munis lost about $88 million this week. If we take it one step further to look at municipal bond funds, it's very small groups. I don't usually put up a slide for this. Municipal bond ETFs basically saw inflows about $256 million. It's the first week in 3 that they've seen net inflows. Well, we're really now turning toward our attention to kind of the big outflows that happened, and they were in money market funds. And we've been seeing some significant outflows from money market funds. Maybe it had to do with, paying of taxes, later in the time period. It's really going to turn out to be primarily institutional in nature. Let's go ahead and take a look at that group. Basically, money market funds lost about $27.4 billion. The 7th consecutive week they've seen outflows. These outflows are actually pretty big. Week before it's $41.3 billion, and we can keep going back and see some pretty pretty hefty numbers. How it broke out, though, is taxable money market funds handed back about $26.5 billion. And what we saw was institutional investors, and these are institutional funds, so they could be our 401ks and the like, but again, in the behavior that's going on, it makes me think it wasn't. $32 billion in outflows from institutional funds, while retail investors, and this is retail money market funds, took in about $5.5 billion. And the tax-exempt money market funds saw about $944 million in net redemptions. And again, this might make sense. If we take a look again back at the muni bond funds taking in $749 million, people are putting money back to work in areas that they think are going to work in the coming weeks and months. Well, that's basically it for me this week. Basically, a couple things that comes to mind. Basically the market remains volatile. Actually, today's Friday. We saw that some of the indices actually finished up, or it was really kind of a mixed session, but nothing big to write home about. But the day before, on Thursday, we saw some actually pretty big losses in the market once again. So I think people are still trying to get their footing and understand what's happening in the market. And basically, I think what people are keeping an eye on is Congress's inability or lack of want to basically put together another fiscal stimulus bill. And a lot of analysts feel that this is something that's probably not going to happen anytime soon. If it does, it'll probably be a watered down version, because the unemployment rate is looking good. We are regaining jobs. 8.4% unemployment certainly is bad in comparison to what we had 6, 7, 8 months ago. But again, the numbers are looking better. We're getting numbers in there. But I think people are also keeping an eye on the initial jobless claims, and those have been hovering, and a little bit less, but hovering around the million person range, which is actually quite high. And continuing unemployment numbers are actually fairly high as well. So I think people are going to keep an eye on that. And I think the basic issue that has been driving a lot of the market is the market overvalued. Do the FANG stocks and the home improvement stocks and kind of these stay-at-home stocks that people have been jumping into and betting up. Are they worthy of the multiples that they're being set at? And I think some of the answer is, a lot of people think it again is a little dear, a little pricey, and they're waiting for if you will, a relief. We've been on an upward trend for several months now, and I think people are looking for that back off. But anyways, if I haven't done a deep enough dive for you, you can go to our site at www.lipperusfundflows.com, or you can join us next week when one of the analysts will talk about flows trends for that week. Thanks for joining me. My name's Tom Roseen, wishing you the best in your wealth planning and creation.